Hello and welcome to Policy Watch, your packed snapshot of the week's biggest business stories, its context, its relevance and policy impact. I'm Govindraj, Ethiraj. The Rajya Sabha has passed the Insolvency and Bankruptcy Code 2016, a reform move that should make it much easier to do business. The bankruptcy bill, which will replace all existing bankruptcy laws and cover individuals, companies, limited liability partnerships and partnership firms, will ensure time-bound settlement of insolvency and enable faster turnaround of businesses. It will, if it works as expected, help creditors recover loans faster. Now, getting this new code to work will need much more work, such as a regulator and information utilities. The larger question we're asking is, will this make a real difference in the ease of doing business scale, and what more needs to be done? Joining me to discuss this are KV Karthik, Partner, Financial Advisory Services at Deloitte, and Krishnan Sitaraman, Senior Director, CRISIL Ratings, looking after financial sector ratings. Gentlemen, thank you both for joining us. Karthik, let me begin with you. So what does this bill broadly do, and what does it replace in real terms? And what will it actually transform?
Okay, let me take a step back. So, what were we looking at before this bill? So, there were a number of legislations. So, besides Companies Act, you had SICA, RDDB, and SARFAESI. And particularly when you look at SICA, it talks about 100% net worth erosion. When you talk about Companies Act,
SIC Industrial
Companies Act, and under your Companies Act, we are talking about failure to pay at least 50% of the secure creditors. What it does now, this new bill, is that any trigger for insolvency or resolution process can be triggered, but not just by a financial creditor, but also an operational creditor, including workers and people who have not been paid their dues. They can trigger this process at the time of default.
Okay.
So that's the first important step.
But is that a good thing? I mean, it could also have a flip side, right?
No, it's important because what usually happens is, when you look at what is happening now, is you need to resolve the process not after a lot of time has passed, because one of the problems that many of the financial institutions and banks face is, by the time they go to recover their assets, either the assets are not there, or it's either negligible in value or nil. So what you're trying to do is, early signs of distress that you identify, you're trying to come to a resolution process, whether it is
so you're saying that the trigger is the main thing, so you're able to get things moving quickly, as opposed to earlier maybe it would go on and on forever.
Absolutely. And you have 180 days with a flexibility of another 90 days to come to a solution.
Right. Okay. So we'll talk about what else this requires to get it really going. Krishnan, let me come to you. What in your mind is this going to do for the financial system, the sector that you track closely?
Yeah, the way we look at it is that the lenders, essentially bankers and asset reconstruction companies, these would be the most immediate beneficiaries. But I think this code in itself is a watershed reform, and that will improve the ease of doing business in India over the long run. In terms of the rankings that India is around 130 or so, that's going to move up. And also in the long run, what it will do is, apart from enhancing creditor rights, it will also boost investor confidence, and also strengthen India's corporate bond market by deepening it. Now, how it will do all these things are in a set of steps, by building an ecosystem which involves an insolvency regulator, insolvency adjudicating authorities, insolvency processes, insolvency professionals, and so on. So once all this is done, what this code will do is simplify the legal processes of identification and resolution. It will preserve value for creditors and also give them greater certainty of outcome of the entire process.
Krishnan, do you have any estimate of what this could unlock in terms of maybe litigations that are going on, or processes that have not reached their conclusion so far?
Yeah, so let me look at it this way. So today, if we look at asset reconstruction companies in India, we are looking at recoveries in the region of around 35 to 36%. And the time taken for resolution of such stressed exposures is around, on an average, around 5 years. Now, what we are looking at here is that process is going to considerably hasten. The recovery process will fasten, become more faster, and it also enhanced the recovery levels because of what has already been mentioned, the timeline of 180 days. In certain cases, it can go to 270 days. But there is a specified process, a specified ecosystem being put in place, which will increase the recovery rate from the current levels. And once that happens, what we are looking at is release of capital among other things, and that will also help in credit expansion. Just to give you some numbers, a World Bank report says that recovery levels in countries like Japan, that is in the range of 92%. So what we are looking at is an increase. How much it is going to be, that is something which need to wait and watch. The actual implementation of the code, the setting up and
so when you say 92% or 36% that you referred to earlier, this is the money that, I mean, what the 1/3 or in this case 92% of the money that was invested or lent to these companies coming back. Is that right?
That is right. That is right. Once the insolvency is identified and how much of it comes back, yes.
Right. Okay. Can I come back to you? So one of the questions is, we always hear about Chapter 11, and that seems to be a smooth transition process for a company that has gone bankrupt or a business that's failed. Does this come anywhere close to that, or are we looking at something similar?
Okay, so let's talk about what a good bankruptcy law should look at. Primarily, there are two aspects. There will always be a conflict, should I say, between a creditor and a debtor. And that could be a variety of reasons. One is because asymmetry of information. Many of them, the management of the company will have better information, so they are in a better position to negotiate, which the creditors might not have. The second is the approach to resolution. The creditors would like to get their money back quickly so that they can put it into more productive uses, while the debtor would like to continue. That is number one. And the second is that what is the value you are looking at, value creation or value destruction, because at the end of the day, if a business fails, there could be a number of reasons for it, but can you salvage that, or you have to just
so do you have a sense on how many businesses fail in India, and to what extent are we saving those who are likely to fail or have failed already by obviously having a speedier resolution process?
So that is where I am coming to is, I don't have numbers to justify it, but from what my experience suggests, that since we are going for a trigger at an early sign of stress, there is still a process where you can salvage the value, and most important thing is we are moving from a debtors in possession to a creditors in possession. So we are bringing all of them on the same table, and creditors have important right in that decision making, because it's their money at stake at the end of the day. So they will also like to salvage as much as possible. It does not mean that they would like to sell off the
Krishnan, if you were to, I don't know if there's a rough estimate you can put at companies which are potentially ready for this new bill, in as much as we've not allowed them to fail in the past because of all the problems that we've spoken of. Would you see that number? Would we see a dramatic number there?
So let me try to draw an analogy. So our estimate of weak assets in the banking system is that it will be around 8 lakh crores by March 2017. So a large part of that would bankers will try to use this code to kind of recover from there. But the way we look at it is from the existing weak assets platform, we are not expecting too much of a move overnight, because we still see a large portion of that coming in from large corporates who have leveraged balance sheets, and they are investment driven, impacted by fall in commodity prices and so on. Many of those large corporates could potentially approach the legal system separately, and we will need to wait and watch as to how this entire bankruptcy code is implemented, whether it is implemented in letter and spirit, or it will run into some roadblocks. That is something which we need to wait and watch. We believe that it will take around 3 to 5 years for this entire ecosystem to be set up and stabilized, because there are certain steps which need to be done. So I think the traction will happen after that time.
Karthik, if you were to look at now the steps ahead, right? So we've talked about building this ecosystem which has a regulator, which has professionals who will obviously work on this, and the information utilities. Now, what else do we need, or is that the laundry list that covers it all?
These are the should I say, as the first important
Prerequisites.
because without this, the whole the edifice of this law will not really function. So to answer that, yes, these are the first important things. But we still had, if you look at information utilities, you still had certain information. You had an MCA, you had an ROC where you had to put in. So it's not that it is completely non-existence, but you still have some utilities, but you need to spruce it up to add more utilities and get that. Because what most important thing is, if you want to trigger this process, the moment I have created a liability, or probably a creditor has gone and registered his liability, and he is able to showcase that there is a default on that particular liability, then easy for him to trigger that process. So it's not just creation of utilities, but also the way your lenders and creditors will be utilizing this utility. That is when the success of that law will.
Right, but you're on the whole, you're optimistic that this is something that will actually help ease business or ease of doing business scale.
Yes.
We've run out of time. Thank you so much, Karthik, and thank you, Krishnan, for joining us. We need to go in for a break now. Coming up on the other side, we talk about the new Mauritius treaty, which is going to play out in coming years. Stay with us. Welcome back to Policy Watch. India has signed a protocol amending the Double Taxation Avoidance Agreements, or DTAA, with Mauritius. Now, what this means is that from April 2017 onwards, investments made into India via Mauritius will be taxed at 7.5% for listed equities and 20% for unlisted ones. Now, the tax slabs will rise further to domestic rates of 15 and 40%. While there was some fear on whether the stock markets would react negatively to this development, that has not happened. The larger question is, what does the Mauritius tax treaty do for India, and what kind of signal does it send out? More importantly, what should India be doing to be perceived as an investor-friendly destination for portfolio as well as direct investments? To discuss this, I'm joined by Dinesh, Kanabar, CEO of Dhruva Associates, and Suresh, Swamy, partner at Financial Services Tax, PwC. Thank you both for joining us. Dinesh, let me begin with you. Now, this has been a long time in coming. We signed the agreement with Mauritius in 1983. Now, this is 2016. Is it correcting what was the errors of the past, or is it more like an evolution?
So over the last 15 years, there has always been this question as to whether Mauritius is being used for treaty shopping for investments into India, and whether India is losing substantial tax on account of that, number one. And therefore, there have been a number of meetings in the last several years between the two sides to try and amend the treaty. It hasn't worked till now. There have been two developments which happened in the recent past. One is that the general anti-avoidance regulations are coming into play with effect from 1st April 2017, which would provide a domestic override to the tax treaty, because GAR provisions override the provisions of the tax treaty. And therefore, it was inevitable for a framework to be built around the treaty to address GAR. And second, the OECD came out with BEPS action item, base erosion and profit shifting action items, where it was acknowledged that while the tax treaties were there to avoid double taxation, equally they should not promote double non-taxation, which is what in most cases the India-Mauritius trade did, because people made investments into India, didn't pay taxes in India, and did not end up paying taxes in Mauritius. So this was long in the offing and is addressing the evolution of tax policy and laws as they evolve globally.
Right, thanks for that. So let me come to you, Suresh. So does this also mean that people can actually now look for other places that they could bring their investments through, like Singapore, for instance?
So I think as Dinesh mentioned, with all this evolution of GAR and BEPS, I think gone are the days where you probably will use some platform to treaty shop. Unless and until you have a proper substance in a particular jurisdiction, it's going to be increasingly difficult for people to actually set up or look at other jurisdictions.
So it's going to be difficult because of what the laws in India say, or the laws in the counterpart?
So I think the laws, as far as India is concerned, GAR is coming right, from 1st April 2017. And GAR is going to increasingly look at substance which people have in other country. So India has treaties with Singapore, it has treaty with the Cyprus, it has treaty with Netherlands, which provide somewhat similar benefit. But the question will be that what can say, for example, a US investor set up something in Netherlands and come into India. He will still have to prove that the substance in Netherlands is robust enough for him to actually access the treaty.
Right. So it has to be a real business or a real intermediary sitting in Netherlands, which was not the case in Mauritius. Okay, let me come back to you, Dinesh. So will this impact investments? I know that the markets were expecting a shock, but that did not happen. But are we looking at any sort of impact in the medium to long term?
If you look, as we discussed earlier, the fact that India-Mauritius treaty would get amended was sort of long anticipated. In fact, at this point of time, there was an uncertainty as to what would happen post the general anti-avoidance regulations coming to the investments coming into India from Mauritius. So this in fact provides now a framework. And why this framework really is very effective is, number one, because there is a grandfathering of tax regime for all investments that are made before 31st March 17. So look at it this way. A portfolio investment may get liquidated quickly, but a private equity investment made, say, in March 2017 would most likely get liquidated after 5 years, 7 years. If it's a convertible, it could get liquidated after 10 years. And through the life of that investment, whenever this investment is sold, you're going to get benefit of the tax treaty. Very, very critical. Similarly, investments made between 17 and 19 would get grandfathered for a 50% tax exemption, provided the LOB conditions are met at the time of disposition. So I think people have come to recognize globally that there cannot be a situation of not paying any taxes at all. The Supreme Court of India blessed India-Mauritius Treaty in Azadi Bachao Andolan, which was several years back. If today that judgment was rendered, I would wonder whether the Supreme Court would have blessed treaty shopping the way it did several years back.
So, Suresh, what's your sense when you talk to companies who are investing or wanting to invest in this country? To what extent is tax playing an important role? As by extension, to what extent is tax a critical factor in even coming into a country like India?
So, I work with a lot of foreign portfolio investors and foreign funds investing in India. I think the key element for them is always to be how the performance relative to other funds, right? And tax is an element. They never want to be in a situation where they are taxed more than what the other funds are really paying. But in this situation, what's going to happen is all are going to be equalized, right? Everyone is going to end up paying the same amount of tax. So therefore, in the whole structuring bit, I would presume that tax is now probably not going to be such a big driver. It will be more the economics of India, investing in India. That's going to play much.
That's an important point. So, Dhruva, very quickly, Dinesh, if you were to look at competing markets, let's say China, which we tend to compare ourselves with, China, as I understood from you earlier, does not have a differential tax system.
So the way, let me just elaborate on what was your question earlier as to how important is tax. And to say that tax is not important may be incorrect. But I think what most people are really worried about is not tax per se, but it's really about certainty on taxes. Foreign investors, when they go into a country, want to have a certain tax regime. They need to know what is the outcome, and if that is the outcome, what is the tax implication on that outcome. In a situation where there is uncertainty, they cannot really compute the returns, and when a person can't compute the returns, that's when issues start to arise. Therefore, to my mind, the moment you have a framework and a rate of tax which is negligible, so for example, under domestic law today, sale of equity on stock exchange, if it is long term, is tax free. Therefore, all of those investments don't need to worry. It is only where long term, it's only when shares are sold on the stock exchange and it's a short-term gain that there is a 15% tax which will be 0 till 31st March. For the next 2 years will be 7.5%. Now 7.5% tax is not something which one would regard as not conscionable. And finally, if you are looking at unlisted equity, there is a 10% rate of tax, and then after which will go up to 20%. But that again is not something which is unconscionable, and that is what foreign investors would love. And to your question on China, the Chinese markets really do not distinguish between business income and capital gains, and such gains are normally taxed as business profits.
Right. So, way forward, Suresh, what else is to be done? Is this enough? Do we need some corresponding changes in guidelines or rules?
So I think this is just a protocol which has come. This has to be notified. So once it is notified, you probably will see that it is taking effect from 1st April 2017. I think on the other side, on the domestic side, there is people are awaiting on guidelines on GAR. How is GAR actually going to play out? So as far as this particular treaty is concerned, while it takes away the exemption with respect to shares, the exemption with respect to other class of assets continue.
Yes. Yeah, like
right?
mutual funds, derivatives,
mutual
and
fund
debt,
derivatives, they continue.
Yeah.
So people who are going to use Mauritius to come into India, they may still have to worry about how the general anti-avoidance rules guidelines really play out. So I think they are eagerly awaiting for those guidelines, and probably they'll have to take a judgmental call after once those guidelines come. They will probably have.
Yeah, but just to conclude, I mean, we go back to your first point, and which is what I think Dinesh also has been saying, that fundamentally things are evolving on the tax front, and that it has to be genuine, and you have to be doing business in a way that doesn't look like you're treaty shopping or you're trying to avoid tax.
Absolutely.
Right?
Absolutely.
And that's the way the world is.
Absolutely. I think the world over, I think people are moving towards a situation where you don't really treaty shop. You basically have enough substance in the country where you're coming from, and then it's a bona fide business, and that's how you really claim treaty benefit.
Right. So before we go, State Bank of India's team of economists has released a report saying all is fairly well when it comes to high levels of debt with Indian companies. The over-leveraging is not as bad as some research reports suggest, notably by Credit Suisse have claimed, says the SBI team. According to them, net worth, cash in hand, investments and market value of assets should also be measured. Joining me to discuss this further is State Bank of India Chief Economist Dr. Soumya Kanti Ghosh. Right, Soumya, thank you very much for joining us. So let me ask you the first question. Why is net worth more important than the outstanding debt of companies that we should be looking at to understand how indebted or over-leveraged they are?
See, I'll tell you one thing over here, Govind. The point is that you can look into the debt either way. You can either look into the EBITDA ratio, the interest coverage ratio, and then infer that the company has a high level of leverage, which nobody is denying. In fact, we also not deny that the corporate sector in India is leveraged. But the point to note is that at the end of the day, what is more important is the repayment capacity. So even if I am a leveraged lot, if I am able to repay given my assets, then I think that's not a problem, and that is exactly what this report points out, saying that most of these companies which are possibly there in so-called house of debt are actually very good assets, and a very high net worth, which again is the book value of the net worth, which will allow them to repay the debt over a point of time. And that is exactly which is happening today, because if you look into another table which is coming out in that report, which says that in the current year of around 60 companies, 7,000 crores of debt has been repaid, and we are in fact tracking this debt monitor on a continuous basis, and I can tell you that there is a significant amount of debt which these corporates are trying to repay by leveraging on their non-core assets. So that's the point which you want to mention in this report.
Right. So here's a question I have to ask you, Soumya. Does State Bank of India have an interest in many of these companies, and to that extent, are you presenting a rosier picture than perhaps it is?
Not exactly like that one, because I should not try to put it in that manner. But obviously, very honestly, State Bank has an exposure across sectors and across infrastructure sectors which are not doing that great today. But I think the important thing to note over here is that all these companies over here are now actually in the investment stage. So once the cash flow starts coming in, and that's the point which we wanted to mention in terms of the net worth, and there are examples in the public domain where companies with high net worth has actually been able to come out of the rut and repay the entire debt. There are several examples in the Indian context. For example, Indocount Industries is one of them which has done the same. So my point is that it's fair to say that our bank has an exposure, but to link it with this debt leveraging may not be exactly correct.
Right. So, Soumya, I was looking at the table, but you have one table which shows a high level of debt, but that's not the same as the ones which are actually deleveraging or reducing their debt levels. So, the two are really distinct, aren't they?
No, yes, I think that's a very important point you mentioned. I am glad that you asked me this question. I think there are two things over here. I mean, if you look at the table, the first table talks about the sectors which the house of debt has talked about, and the second table talks about the actual sectors which has deleveraged in the last fiscal, which is not an apple to apple comparison with the first table. Coming back to a point of why there is no apples-to-apples comparison, the point which I want to mention over here is that the sectors which are deleveraging, for example, fertilizer is one of them, aviation is one of them, finance is one of them, are some of the sectors which are witnessing a lot of policy changes because of the global benign global atmosphere, and also because of a policy. For example, in the fertilizer sector, the first time urea based plants are coming up in India for the first time possible in the last 20 to 25 years. So that's why you will see that that sector has in fact been upgraded to positive outlook by even the rating institutions. Now, if an aviation sector, for example, is witnessing a gain because of the decline in the oil prices, finance is also one of them. Now, if you come back to but these are all sectors which have already deleveraged in FY16. Now, there is a distinction between sectors which has already deleveraged, which are in the process of deleveraging, and these are the sectors which are in, for example, in table 1. And our estimates show, which in fact we are going to come out with another report next week, which is actually estimating what is the total value of the debt in the pipeline which these companies which are supposed to be highly leveraged are going to deleverage in the next fiscal. And our estimates show that number could be as high as 1.5 to 2 lakh crores. So basically this is the number which you asked me about relating to table 1, which is an ongoing process, and table 2 it's already done. So, and another point which I want to mention over here, just one last data point, in FY15 based on the all completed set of results, rupees 50,000 crores was the deleveraging, and in FY16 as of today 7,000 crores has been deleveraged, and we expect this figure could be closer to 1 lakh crore at the end of the day when all the results are declared.
Last question, Soumya. So what's your outlook given the fact that interest rates have been edging lower, the transmission is much better? So do you see a positive impact on the balance sheets of companies and thus the reduction in over leverage that we've been talking about?
No, I think this is going to have a positive impact on the level of debt, but interest rate need to come down further, and I think that irrespective of the whatever is that, if the interest rate comes down, then it may be actually easier and faster for this company to deleverage. So for our outlook for the next 2 quarters is that this process will continue. Possibly this may not be immediately impacted on the ground in terms of the outlook, but if you look into the profit margins of most of the companies, there is also a table in the report which shows that the profit margins have actually increased by 14% in the last quarter of this fiscal. So there is a turnaround, there is a visible turnaround happening, but our sense is that this will be slow and gradual over the next 2 quarters.
Right. Soumya, gentlemen, thank you very much for joining us. We've run out of time completely. That's all we have on this edition of Policy Watch. We'll be back next week, same time. Thanks for watching.